All right, welcome to our executive summary webinar on the Countryshire apartments. This is FTW Investments. We're going to jump right into the content for tonight. First off, we have to give a disclaimer and a confidentiality disclaimer as well. This OM, or this offering memorandum, is not meant for you to make any investment decisions based on. Please review the full private placement memorandum and seek any counsel that you need to make your investment decisions. This is required for us to say, and it's something that everybody needs to read. Here's our team. This is Logan Freeman here. I'm a co-founder and principal at FTW Investments. Joined with me tonight is Parker Webb, and Corey Tuck is our Chief Investment Officer. If you guys want to learn more about our team, feel free to reach out to us. We'd be happy to connect with you, and you can check out our website as well. We're going to jump right into the project, Parker. So let's give a quick description of the property and tell us a little bit about what the investment looks like.
Absolutely. So Countryshire Apartments is a stabilized asset in South Kansas City, 26 units across duplexes and fourplexes that all make up one cohesive property, one cohesive investment, a blend of 2s and 3 bedrooms predominantly. We're acquiring this property for 1.9 with a total cost of $2,225,000. That includes soft costs, due diligence, closing costs, acquisition fees, etc. We are projecting a year one NOI of $140,000, which is mostly based on existing in-place rents. As we mentioned, this is in Kansas City. If you're not familiar with Kansas City is the 31st largest metropolitan area in the United States, 2.1 million people. Median income about $63,000, just above national average, and a median home price of $166,000. So here's a summary of our terms about this offering. We are raising $800,000 for the purchase of this. That'll be $800,000 of Class A membership interest in 8605 Countryshire Partners LLC, which is a single we have formed for the purpose of owning this asset. We will be holding this for a period of 10 years with an expected refinance in year 5. Our minimum investment is $35,000. So the terms of this investment for the investors is we are offering a preferred return of 8.5%. What that means is that investors must first make 8.5% on their invested equity annually before any participation from the sponsors. Over and above the preferred return, investors receive 70% of the net cash flow and sponsors receive 30%. We will be taking an acquisition fee as well as an asset management fee. The asset management fee is equal to 1% of total funds under management, which means 1% of the invested equity. This is on an annual basis and will be paid quarterly.
And Parker, let's talk about really quickly on the preferred return, how we're approaching the first quarter distributions, because I know that's something we covered previously, but I think we need to mention that what we're doing for our operating reserves.
Absolutely. So part of this is that we are raising, as part of the acquisition, $2,000 per unit in working capital upfront. That means we'll have that sitting in an account, sort of rainy day fund that allows us to deal with any issues that may pop up, whether it be a capital need or it be some issue related to the economy where collections suffer. So we're very conservative on the underwriting, so we bring $2,000 to the table up front. Plus, the first partial and full quarter, we will not be making distributions, but instead we'll be holding the excess cash flow as part of that working capital account balance. At the end of the first year, if all is in order, we can distribute that at that point in time. But to have a little bit of extra cushion on the front end of this, we're going to retain the first partial and full quarter of distributions.
Great. Thank you for that. Let's talk a little bit about the strategy on this property.
So this is a stabilized property. It's 100% occupied, but the big benefit here is that the seller is what we would call a mom and pop operator. He's been doing all the work to the property himself, and been managing it himself, and frankly has favored 100% occupancy as opposed to maximizing net operating income. As such, on a per square foot basis, these rents are 31% under market. So we see a substantial ability to go and raise those rents over the first 3 to 4 years. We're anticipating a 7% annual growth over the first 3 years to catch up to market. And then we have, in our assumptions, inflation at 2.5% on both income and expenses from year 4 forward. We have secured a $1.425 million loan with a 25-year amortization and a 4.25% interest rate. That'll have at least 1 year of interest only. And based on these assumptions and having those cash flows flow through the waterfall model we spoke of earlier, we project a 2.63 investor equity multiple over 10 years, a 17.46% investor IRR. Year one, we'll have an 8.7% year one cash on cash, and an average cash on cash is 7.5%.
Fantastic. Thanks for walking us through that. Can you talk us to us just a little bit about the difference between the average cash on cash and why it's going down over the lifetime of the period of the investment, and just walk folks through kind of the refinance strategy that we've got, and make sure we understand what happens during that refinance.
Absolutely. So one of the things that's interesting about the way that we're calculating that average cash on cash is that, first off, year one will have interest only debt. That's why you have a little bit higher cash on cash year one. Second off, year 6 through 10 in our model, that is past the point of doing a refinance. And so when we do that refinance in year 5, we'll actually be able to take out all of the initial invested equity. And then we will be, what we say, playing with house money at that point. But we'll have all of our equity back, plus we'll put some extra cushion in our pocket, and then still investors will be participating in the cash flow from year 6 through 10. So why that kind of dampens the cash on cash is that we're still calculating that number based on the original invested equity rather than the investor's capital account. If you calculated it based on the investor's capital account, year 6 through 10, that return would be infinite. And the cash on cash years 1 through 5 is higher than 7.5%.
It needs to be noted too, we do have this term sheet from the Kansas City Bank that we've talked about, but we did receive a new term sheet with much better terms. And so that very well will help to boost the returns, but this is what we feel comfortable with showing right now. If and when we accept that new term sheet, we can readjust these numbers, but we didn't get that term sheet till earlier this week. And the rates are 3.5%, I believe, Parker?
3.25 with 2 years.
3.25. So that's going to help these returns immensely. The conservative underwriting piece, I think, is an important piece to talk through very quickly, because we are not of the notion to flash high IRRs and not actually hit them. I think there's been kind of a change in the marketplace where a lot of folks are flashing these high IRRs, meaning their terminal cap rates are typically much lower than their entry cap rate. And that's making their deals look a lot better. And that's not something you're going to see with us. And so I think that's one thing that you need to think through. And from the operational expenses standpoint, Parker, let's touch on that as well. Your strategy from, grossing up the real estate taxes, which is another mistake that I see a lot of folks not doing. And then us actually increasing the operational expenses that we believe this property should be operating at.
Yeah, so happy to talk through that. One of the things that we see that people miss all the time is that typically in most counties, real estate taxes are triggered at a sale, and in Jackson County, it's every 2-year taxes are assessed, but the recent sale prices do come into effect for that calculation. And so what we do is we make sure that we're accounting for that. We make sure that we gross up those taxes based on what we anticipate those taxes to go to. And now that's not to say that we're not going to go argue and have an argument with the county about value and try to bring that value down, but I'm also not going to put together a business plan that expects the government not to do its job.
Absolutely.
And one other thing to note about that too, Logan, is, this is a 10-year hold, and over 10-year holds, you're naturally going to have a lower IRR, right? And a lot of these guys go out there and they project 3 to 5 year holds with flipping it and adding some value and getting this large IRR. The issue with that is you have to either go find a way to replace that cash flow and put it into another deal, or you got to pay the taxes.
That's right.
So our ability to go and refinance, to re-deliver that capital back to investors and continue to cash flow this asset and benefit from its appreciation is huge.
Absolutely. Thank you for walking us through that. So how are we actually adding value to this property here?
So again, as we said, this is a stabilized property. It's been taken very well care of. What we will be doing though is as we turn over those units and push that rent to market, we'll be doing light upgrades, replacing flooring in some of the units. Some of the units might need some countertops, might need some fixtures, light fixtures, plumbing fixtures. But again, it's going to be one or two of those things in each unit, not all of those things in every unit. So we're basically going to freshen these units up and then bring them back out to market. This is a 1 to 2 week turnaround on these units. This isn't a long delay, total gut job.
Okay, fantastic. All right, let's jump into a quick financial analysis on what a $100,000 investment might look at like. Parker, you put this together that I definitely want to share with folks so they can actually see what this looks like from a $100,000 investment piece. So if you could, just walk us through what this graph is showing us and what this is illustrating.
So the red bars here are the cash flow from operations. So this would include the investor's preferred return and any proceeds over and above the preferred return that they're going to get on an annual basis. The blue bars are the refinance proceeds and sale proceeds. So what you see here is this is a cumulative cash flow model. So you can see basically how each year we get from that $100,000 investment to that 2.6 equity multiple through the cash flow from operations and the appreciation, which we capture at both the refinance and the sale.
I love the way that this illustrates this because the equity multiple piece is something a lot of folks show, but not a lot of time do you actually understand how that's actually getting to that multiple. So thanks for illustrating this. This is definitely a property that meets my ideal criteria. It has strong in-place income. We can utilize cost segregation study and our bonus depreciation for the depreciation standpoint. We're going to get equity build up by paying off our great loan that we're going to be securing, appreciation over the 10-year period, and then obviously leverage on the dollar that we've invested in this project. So I love this project from an ideal standpoint. And last thing I want to touch on before we jump into how to reserve your spot on this, Parker, is the collections for April and for May. And I think it's important for us to notate what those came in at and, what we're going to be doing just going forward to make sure that we, preserve our investors' capital.
Absolutely. So April collections were at 100%. There was, a delinquency, but he paid before the end of the month. May collections, we have had 2 delinquencies, one of which has already paid, one of which is supposed to pay on May 22nd when he gets his next check. So, everybody's suffering a little bit here, but frankly, collections have been at 100%, and we anticipate May collections to continue at 100%. But again, when we go through and we model these things, we're conservative. And so that's why we're carrying, $2,000 a unit in working capital. It's why we're retaining that first partial and full quarter distribution so that we can, have some extra cushion. And again, one of those things that we look at when we're doing our underwriting and stress testing and frankly, modeling multiple scenarios is we see what the break-even point is. And based on the current incomes with interest-only debt, this property breaks even at 62% occupancy. And with amortizing debt, the property breaks even at 74% occupancy. And remember, again, it's 100% occupied. So we feel like we've got some good cushion on this.
And that occupancy rate as well is well under what this submarket usually sees. So I think that's to be noted. All right, fantastic. Parker, any last thoughts you want to share with folks about the property and this project?
Let's just show them how to find it through our system.
Okay, wonderful. So you're going to head on over to our website, ftwinvestmentsllc.com. You can hit any of these call to action buttons, the upcoming investments, but I like the top right where you're just going to hit invest. And what this is going to bring you to is a sign up page to our investor portal. If you have not signed up for our investor portal, this is the page to do that. If you've already signed up, just scroll down to the bottom and in the right hand corner, you're going to see a login here. When you log in, or when you sign up, you're then going to be directed to this page here where you're going to see active offerings, reservations, and our past offerings. And so the reservations piece is a tool that we use to take soft commitments for our investments to make sure that we understand who's interested in investing in the project. And so you're going to see our 2 offerings or our reservations that we have currently. and you can go ahead and click into Countryshire Apartments, and then it's going to bring up the property page. So you're going to see some pictures. You're going to see the summary. Parker and I also did a teaser video, which is located here. So we have even more information about the project if you want to watch that teaser video. Additionally, you're going to have be able to download the offering memorandum and the pro forma for this project as well in the Documents tab here. So this is the best way to reserve your spot is just to simply go up here and hit Reserve Now. This is not a legally binding commitment. This is you just giving us your intention to invest. So you'll invest as, pick yourself here, the amount that you are interested to invest in. Our minimum is $35,000 on this project. You hit Reserve and we will get a notification. We have raised just about 35% of this project already, and we foresee this being completed easily by the end of next week. And so next week, we're going to be transferring this from a reservation to a full offering. And what that full offering means is we're actually going to have our private placement memorandum in the portal for you to actually go review, and you can subscribe using the subscription agreement that's in that PPM. We'll notify everybody when that happens so you don't miss out on your reservation spot. But that's the process that you need to follow here just to reserve your spot here. We had over 60 folks on our webinar, so we're very excited about this opportunity and overwhelmed with the support that we've had. Parker, any last thoughts?
That's it, Logan. Thank you very much.
Thanks for walking us through this, guys. And always remember, if you're going to do anything, go for the win.